of Management Studies IGNOU presents an audiobook on the course Mmpc 017 Advanced Strategic Management for MBA program. Presenting Block 2 Corporate Level Growth Strategy. Unit 4 Integration and Diversification Growth Strategies Part 1.
Objectives. After reading this unit, you should be able to acquaint yourself with the various diversification strategies. Explain the reasons for pursuing diversification strategies. Explain the various routes to diversification. State the mechanics of M&A and the basic steps involved in M&A. Explain the rationale behind M&A. Identify the attributes of successful and effective acquisitions and present a brief overview of the M&A scenario in India. Diversification. Diversification involves moving into new lines of business. When an industry consolidates and becomes mature, most of the firms in that industry would have reached the limits of growth using vertical and horizontal growth strategies. If they want to continue growing any further, the only option available to them is diversification by expanding their operations into a different industry. Diversification strategies also apply to the more general case of spreading market risks. Adding products to the existing lines of business can be viewed as analogs to an investor who invests in multiple stocks to spread the risks. Diversification into other lines of business can especially make sense when the firm faces uncertain conditions in its core product market domain. While intensification limits the growth of the firm to the existing businesses of the firm, diversification takes it beyond the confines of the current product market domain to uncharted and unfamiliar product market territory. In other words, this strategy steers the organization away from both its present products and its present market simultaneously. Of the various routes to expansion, diversification is definitely the most complex and risky route. Diversification approach to expansion is complex since it seeks to enter new product lines, processes, services or markets which involve different skills, processes, and knowledge from those required for the current business. It is risky since it involves deviating from familiar territory, familiar products, and familiar markets. Diversification of a firm can take the form of concentric and conglomerate diversification. Concentric related diversification is appropriate when a firm has a strong competitive position but industry attractiveness is low. Conglomerate unrelated diversification is an appropriate strategy when current industry is unattractive and that the firm lacks exceptional and outstanding capabilities or skills in related products or services. Generally, related diversification strategies have been demonstrated to achieve higher value creation, profitability, and stock value than unrelated diversification strategies. The interpretation of this finding is that there must be some advantage achieved through shared resources, experience, competencies, technologies, or other value-creating factors. This is the so-called synergy effect of diversification, that is, the whole is greater than the sum of its parts. While it is difficult to predict what is a synergistic match of a business to an existing corporate portfolio, the test must be that the business creates new value when it is added to a corporation's line of existing businesses. Related diversification, concentric diversification. In this alternative, a company expands into a related industry one having synergy with the company's existing lines of business, creating a situation in which the existing and new lines of business share and gain special advantages from commonalities such as technology, customers, distribution, location, product or manufacturing similarities, and government access. In essence, in concentric diversification, the new industry is related in some way to the current one. This is often an appropriate corporate strategy when a company has a strong competitive position and distinctive competencies, but its existing industry is not very attractive. Thus, a firm is said to have pursued concentric diversification strategy when it enters into new product or service area belonging to different industry category, but the new product or service is similar to the existing one with respect to technology or production or marketing channels or customers. Such diversification may be possible in two ways: internal development through product and market expansion utilizing the existing resources and capabilities, or through external acquisition operating in the same market space. Addition of these finance activity in India is a case of market-related concentric diversification. Another type of concentric diversification is technology-related, in which the firm employs similar technology to manufacture new products. Addition of tomato ketchup and sauce to the existing Maggi brand processed items of Food Specialities Limited is an instance of technology-related concentric diversification. Unrelated diversification, conglomerate diversification. Conglomerate diversification is a growth strategy in which a company seeks to grow by adding entirely unrelated products and markets to its existing business. A company that consists of a grouping of businesses from unrelated streams is called a conglomerate. In conglomerate diversification, a firm generally introduces new products using different technologies in new markets. A conglomerate consists of a number of product divisions which sell different products principally to their own market rather than to each other. Conglomerates diversify their business risk through profit gained from profit centers in various lines of business. However, some may become so diversified and complicated that they are too difficult to manage efficiently. However, since their huge popularity in the 1960s to 80s, many conglomerates have reduced their business lines by restricting to a choice of few. The reasons for considering this alternative are primarily to seek more attractive opportunities for growth, spread the risk across different industries, and/or to exit an existing line of business. Further, this may be an appropriate strategy when not only the present industry is unattractive, but the company also lacks outstanding competencies that it could transfer to related products or industries. However, since it is difficult to manage and excel in unrelated business units, it is often difficult to realize the expected and anticipated results. In India, a large number of companies diversified their operations following economic liberalization. Gujarat Narmada Valley Fertilizers Limited has diversified from fertilizers to personal transport, chemicals and electronic industries, while Arvind Group, hitherto confined to textiles, diversified into unrelated activities such as manufacturing of agro products, floriculture and export of fresh fruits. Likewise, BPL has decided to venture into sectors like power generators, cement, steel and agricultural inputs in a big way. Wipro is another company with wide-ranging business interests encompassing vegetable oils, computer hardware and software, medical equipment, hydraulic systems, consumer products, lighting, export of leather shoe nippers, and has recently entered into financial services. Rationale for diversification. Under strict assumptions of an efficient market theory, there is no convincing rationale for one company to acquire another, especially less efficient or unrelated businesses. Since the markets are imperfect and do not follow the norms of efficient market theory, companies do diversify for several reasons given below. Economies of scale and scope synergy. The merger of two companies producing similar products should allow the combined firms to pool resources and attain lower operating costs. By making optimal use of existing marketing, investment, operating, and managerial facilities of the two combining firms and eliminating redundant and overlapping activities, the combined entity can lower the operating costs and increase operational efficiency. The saving may come from reduced overheads or the ability to spread a large amount of production over lower consolidated fixed costs. There may also be differential management capabilities. An efficiently managed firm may acquire a less efficient firm with the intent of bringing better management to the business. Efficiencies can also be gained through pooled financial resources or simply through pooled risk. Widen market base and enhance market power. Large number of collaborations and acquisitions are aimed at expanding the market for the firm's products. For instance, HCL and Hewlett Packard Limited, Tata, IBM, Ranbaxy Laboratories and Eli Lilly Company, Hindustan Motors and General Motors and Tata Tea and Tetley of USA entered into tie-up arrangements mainly to exploit the market opportunities. Mergers and acquisitions can increase a firm's market share when both firms are in the same business. But market share does not necessarily translate to higher profits or greater value for owners unless the merger substantially reduces the inter-firm rivalry in the industry. Profit stability. Acquisition of new business can reduce variations in corporate profits by expanding the company's lines of business. This typically occurs when the core business depends on sales that are seasonal or cyclical. A large number of organizations pursue diversification strategy just to avoid instability in sales and profits, which can result from events such as cyclical and seasonal shifts in demand, changes in the life cycles, and other de-establishing forces in the micro and macro environment. Improve financial performance. Large firms generate cash that can be invested in other ventures. The firm acts as a banker of an internal capital market. The core business sustains itself on its money-making ventures and uses this cash flow to create new ventures that generate additional profits. A firm may also be tempted to exploit diversification opportunities because it has liquid resources far in excess of the total expansion needs. Sometimes a company may seek a merger with another organization with the intention of tiding over its financial problems. Growth. Diversification is basically a way to grow. Indeed, managers often cite growth as the principal reason for diversification. The most important factor that motivates management to diversify is to achieve higher growth rate than which is possible with intensification strategy. If the management feels that the existing products and markets do not have the potential to deliver expected growth, the only alternative they have is to diversify into new territories. Unlike organic growth, which is slow, an acquisition or merger inorganic can deliver the results rather quickly since resources, skills, other factors essential for faster growth are immediately available. Counter competitive threats. Organizations are driven at times towards external diversification through merger by competitive pressures. Such a strategic move is expected to counter the competitive threats by reducing the intensity of competition. Access to latest technology. Many Indian firms enter into strategic alliances with foreign firms to gain access to the latest technologies without using huge amount of money on R&D. For instance, Johnson and Nicholson India Limited, a leading domestic paint manufacturer, has strengthened its position in the Indian market and also diversified into industrial electronics along with its German partner Karl Schweck AG of Germany. Regulatory factors. A large number of organizations have diversified their operations geographically to exploit opportunities in different regions and countries and also to take advantage of the incentives being offered by the various governments to attract investment. Many companies enter other countries to avoid restrictions placed by the regulators in their host country. Alternative routes to diversification. Once a firm opts for diversification, it must select one of the options discussed below. There are three broad ways to implement diversification strategies. Mergers and acquisitions. A merger is a legal transaction in which two or more organizations combine operations through an exchange of stock. In a merger, only one organization entity will eventually remain. An acquisition is a purchase of one organization by another. There were quite a few acquisitions in which the target firms resisted to take over bids. These acquisitions are referred to as hostile takeovers. It is natural for the target organization's management to try to defend against the takeover. Although they are used synonymously, there is a slight distinction between the terms merger and acquisition. This will be discussed more in detail in the later sections. Strategic partnering. Strategic partnering occurs when two or more organizations establish a relationship that combines their resources, capabilities, and core competencies to achieve some business objective. The three major types of strategic partnership, joint ventures, long-term contracts, and strategic alliances, are discussed below. Joint ventures. In a joint venture, two or more organizations form a separate, independent organization for strategic purposes. Such partnerships are usually focused on accomplishing a specific market objective. They may last from a few months to a few years and often involve a cross-border relationship. One firm may purchase a percentage of the stock in other partner, but not a controlling share. The joint ventures between various Indian and foreign companies such as Hindustan Motors and General Motors, Hero Cycles and Honda Motor Company, Wipro and General Electric, etc. are examples of such strategic partnering. Long-term contracts. In this arrangement, two or more organizations enter a legal contract for a specific business purpose. Long-term contracts are common between a buyer and a supplier. Many strategists consider them more flexible and less inhibiting than vertical integration. It is usually easier to end an unsatisfactory long-term contract than to end a joint venture. A good example is the change in supplier relationships that Chrysler's management undertook after 1989 when it launched the LH project to create a new generation of cars. Supplier relationships are critical at Chrysler since outsourced components constitute about 70% of Chrysler's cars compared to about 50% for GM and Ford. Japanese automakers also enter into such arrangements with their vendors frequently. Strategic alliances. In a strategic alliance, two or more organizations share resources, capabilities, or distinctive competencies to pursue some business purpose. Strategic alliances often transcend the narrower focus and shorter duration of joint ventures. These alliances may be aimed at world market dominance within a product category. While the partners cooperate within the boundaries of the alliance relationship, they often compete fiercely in other parts of their businesses. Mergers and acquisitions M&A. Mergers and acquisitions and corporate restructuring, or M&A for short, are a big part of the corporate finance. 1 plus 1 makes 3. This equation is the special alchemy of a merger or acquisition. The key principle behind buying a company is to create shareholder value over and above that of the sum of two companies. Two companies together are more valuable than two separate companies. At least, that's the reasoning behind M&A. This idea is particularly attractive to companies when times are tough. Strong companies will act to buy other companies to create a more competitive, cost-efficient company. The companies will come together hoping to gain a greater market share or achieve greater efficiency. Because of these potential benefits, target companies will often agree to be purchased when they know they cannot survive alone. A corporate merger is essentially a combination of the assets and liabilities of two firms to form a single business entity. Although they are used synonymously, there is a slight distinction between the terms merger and acquisition. Strictly speaking, only a corporate combination in which one of the companies survives as a legal entity is called a merger. In a merger of firms that are approximate equals, there is often an exchange of stock in which one firm issues new shares to the shareholders of the other firm at a certain ratio. In other words, a merger happens when two firms, often about the same size, agrees to unite as a new single company rather than remain as separate units. This kind of action is more precisely referred to as a merger of equals. Both companies' stocks are surrendered and new company stock is issued in its place. When a company takes over another to become the new owner of the target company, the purchase is called an acquisition. From the legal angle, the target company ceases to exist and the buyer gulps down the business and stock of the buyer continues to be traded. In summary, acquisition is generally used when a larger firm absorbs a smaller firm, and merger is used when the combination is portrayed to be between equals. For the sake of discussion, the firm whose shares continue to exist, possibly under a different company name, will be referred to as the acquiring firm, and the firms whose shares are being replaced by the acquiring firm will be referred to as the target firm. However, a merger of equals doesn't happen very often in practice. Frequently, a company buying another allows the acquired firm to proclaim that it is a merger of equals even though it is technically an acquisition. This is done to overcome some legal restrictions on acquisitions. Synergy is the main reason cited for many M&As. Synergy takes the form of revenue enhancement and cost savings. By merging, the companies hope to benefit through staff reductions, economies of scale, acquisition of technology, improved market reach, and industry visibility. Having said that, achieving synergy is easier said than done. Synergy is not routinely realized once two companies merge. Obviously, when two businesses are combined, it should result in improved economies of scale, but sometimes it works in reverse. In many cases, 1 and 1 add up to less than 2. Excluding any synergies resulting from the merger, the total post-merger value of the two firms is equal to the pre-merger value if the synergistic values of the merger activity are not measured. However, the post-merger value of each individual firm is likely to be different from the pre-merger value because the exchange ratio of the shares will not exactly reflect the firm values compared to each other. The exchange ratio is distorted because the target firm's shareholders are paid a premium for their shares. Synergy takes the form of revenue enhancement and cost savings. When two companies in the same industry merge, the revenue will decline to the extent that the businesses overlap. Hence, for the merger to make sense for the acquiring firm's shareholders, the synergies resulting from the merger must be more than the value lost initially. Different forms of mergers. There are a whole host of different mergers depending on the relationship between the two companies that are merging. These are horizontal merger, merger of two companies that are in direct competition in the same product categories and markets. Vertical merger, merger of two companies which are in different stages of the supply chain. This is also referred to as vertical integration. A company taking over its supplier's firm or a company taking control of its distribution by acquiring the business of its distributors or channel partners is examples of this type of merger. Market extension merger, merger of two companies that sell the same products in different markets. Product extension merger, merger of two companies selling different but related products in the same market. Conglomeration, merger of two companies that have no common business areas. From the finance standpoint, there are three types of mergers: pooling of interests, purchase mergers, and consolidation mergers. Each has certain implications for the companies and investors involved. Pooling of interests. Pooling of interests is generally accomplished by a common stock swap as a specified ratio, at a specified ratio. This is sometimes called a tax-free merger. Such mergers are only allowed if they meet certain legal requirements. A pooling of interests is generally accomplished by a common stock swap at a specified ratio. Pooling of interests is less common than purchase mergers. Purchase mergers. As the name suggests, this kind of merger occurs when one company purchases another one. The purchase is made by cash or through the issue of some kind of debt investment, and the sale is taxable. Acquiring companies often prefer this type of merger because it can provide them with a tax benefit. Acquired assets can be written up to the actual purchase price, and the difference between book value and purchase price of the assets can depreciate annually, reducing taxes payable by the acquiring company. Purchase acquisitions involve one company purchasing the common stock or assets of another company. In a purchase acquisition, one company decides to acquire another and offers to purchase the acquisition target stock at a given price in cash, securities, or both. This offer is called a tender offer because the acquiring company offers to pay a certain price if the target's shareholders will surrender or tender their shares of stock. Typically, this tender offer is higher than the stock's current price to encourage the shareholders to tender the stock. The difference between the share price and the tender price is called the acquisition premium. These premiums can sometimes be quite high. Consolidation mergers. In a consolidation, the existing companies are dissolved, a new company is formed to combine the assets of the combining companies, and the stock of the consolidated company is issued to the shareholders of both companies. The tax terms are the same as those of a purchase merger. The Exxon merger with Mobil Oil Company is technically a consolidation. Acquisitions. As stated earlier, an acquisition is only slightly different from a merger. Like mergers, acquisitions are actions through which companies seek economies of scale, efficiency, and enhanced market visibility. Unlike all mergers, all acquisitions involve one firm purchasing another. There is no exchanging of stock or consolidating as a new company. In an acquisition, a company can buy another company with cash, stock, or a combination of the two. In smaller deals, it is common for one company to acquire all the assets of another company. Another type of acquisition is a reverse merger, a deal that enables the private company to get publicly listed in a relatively short time period. A reverse merger occurs when a private company that has strong prospects and is eager to raise finance buys a publicly listed shell company, usually one with no business and limited assets. The private company reverse merges into the public company, and together they become an entirely new public corporation with tradable shares. Regardless of the type of combination, all mergers and acquisitions have one thing in common. They are all meant to create synergy, and the success of a merger or acquisition hinges on how well this synergy is achieved.
You were listening to the audiobook by the School of Management Studies IGNOU for MBA program. Course code Mmpc 016 International Business Management. Course Coordinator Professor G. Subayama. Voiceover by Chitra. Edited by Ashok Sharma. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.